Yes guys, this is CA Santosh Mehra. I have qualified CA in 2011 and have been actively associated in teaching industry since last 5 years, and I am a diploma in IFRS, have been already implementing your Ind AS and have been qualified trainer by ICAI to train the qualified CAs as far as your Indian accounting standards are concerned. That is a new adoption which has come up in the recent times, probably starting from 1st April 2015. We have been seeing these standards which have come up. And now what we are here to discuss about is the significant changes which have developed as far as your financial reporting paper is concerned or your IPCC accounting paper is concerned with respect to your standards, with respect to your guidance notes are being discussed now. Yes guys, so today we are here to discuss about the changes as far as your accounting standard 10 is concerned. AS 10 has gone for a substantial change. Now subsequent to notifications given by MCA, which is concerning to all the companies, that is the body corporates, starting from 30th of March 2016 for any financial year starting on or after 1st April 2016, and also subsequently even the ICA has come up with a notification on 29th of September 2016 to give an effect for this revised AS 10. Now what is the change? We'll have to probably start with the change in the name itself. Earlier we used to call it as AS 10 accounting for fixed assets, while now we will be calling it as AS 10 property, plant and equipment. The other subsequent change which will also have a crucial impact is that earlier we had AS 6 which was talking about depreciation, but now we will not have AS 6 because even the depreciation on such property, plant and equipment is also dealt as per AS 10. So we can say, or we can conclude saying that AS 6 as such has no relevance as on today. So AS 6 has also got merged into AS 10. So we cannot say that the depreciation standard itself is not there. We do have a standard which is talking about depreciation, but it is included as a part of AS 10, that is property, plant and equipment. Now to talk about property, plant and equipment, what exactly am I trying to include in the scope of the standard? Now this standard talking about property, plant and equipment will concern any tangible fixed asset which is held as a property, plant or equipment. However, it specifically excludes those property, plant and equipment which are dealt as per any other standard specifically. Now what are any other standards specifically? Sometimes you can have a government grant against a property, plant and equipment. Such tangible assets or such property, plant and equipment will not be as per AS 10, but their recognition will be as per AS 12 itself. Something which is acquired under AS 14, that is amalgamation, such standard will actually take care of the property, plant and equipment to be governed there. We will not talk about such things as far as your AS 10 is concerned. Now when we are talking about exactly AS 10, that is property, plant and equipment, there are certain exclusions which he has given specifically. Such exclusions can be broadly put under two things. First one is biological assets, second one is wasting assets. Now what is this biological assets and wasting assets? We'll have to discuss quite clearly. The first one, when we are talking about biological assets, we might sometimes get confused between two different nomenclatures being used here. One is a bearer plant, other one is biological assets. Biological assets are excluded from the standard, but bearer plant is included under property, plant and equipment. Now first of all, we were quite confused with the terminology being used. What is a biological asset? And now I am introducing a new terminology called as bearer plant. How do we differentiate between these two? Now with a simple difference which I can say that a bearer plant is such plant which actually gives rise to an agricultural produce, like a tree which gives you some fruits or vegetables or whatever it is. Now such a plant which is giving rise to an agricultural produce and it is not primarily held for sale. I am not holding the tree for sale. But what am I holding for sale? The produce from the plant is held for sale. Now that one, or it can actually give a benefit of more than 12 months. An enduring benefit which can be derived from such property, plant and equipment or from such plants, we can call them as bearer plants, very much included within the scope of the standard. Then what are biological assets then? Biological assets are basically concerned about that agricultural produce. That agricultural produce cannot be called as AS 10 under property, plant and equipment. It has to be dealt as per AS 2. The simple reason is that it does not have an enduring benefit. Let's say I am talking about sugarcane. What happens in a sugarcane? I harvest the sugarcane, and when I harvest it, the entire plant is uprooted from there. So I don't see anything which is left out, which can be called as a property, plant and equipment here. Now such assets are called as biological assets. Such biological assets do not form part of the standard. They are specifically excluded from the standard. To talk about it, when he specifically talks about bearer plants, the standard gives you certain crops which are specifically excluded under the standard. Number one, those assets which are held for sale. In the sense, I am holding that as only for sale. Such cash crops like rice, wheat, maize, these are called as cash crops. In the sense, we just harvest them, and such harvest is held for sale. We are not going to use it for a longer period of time. Such assets will not be called as bearer plants, cannot be included under the scope of the standard. That is number one. Number two, sometimes there could be some plant which is not only held for produce but also is held for sale. Like you can talk about some trees which gives you an agricultural produce. I have an intention to sell that agricultural produce, but at the same time I am raising the tree for the wood which is there. The wood as well is being sold or being marketed by the primary operations of the business. In such case, such plants will not form part of bearer plants, will again be called as your biological assets itself. For example, you can take rubber. A rubber tree is not just held for the purpose of getting rubber from it, but also is held for its trunk, that is a wood that it provides. So such assets are also called as biological assets. Now, so basically we understood that there are two things which we are talking about. One is a biological asset, the other one that we are talking about is a bearer plant. Now when we are talking about both of them, we need to understand that bearer plant is included within the scope of the standard, while the biological asset is excluded from the scope of the standard. Subsequently, going into the next exclusion is wasting assets. What are these wasting assets? Wasting assets are basically the natural resources which are held for consumption, for utilization. Something like your mineral ores. What happens in a mineral ore? I extract the mineral ore and I sell the product. Now such mineral ores, I cannot call it as a fixed asset, or I cannot call it as a property, plant and equipment under AS 10. They will be dealt as a separate guidance note which has already been given by ICAI in this regard. So this is basically your exclusions from the standard. So two exclusions that I am talking about, biological assets and your wasting assets. Two assets were excluded as far as your revised AS 10 is concerned regarding property, plant and equipment. However, the specific definition given regarding bearer assets or bearer plants will be included within the scope of the standard, that is AS 10. Moving further, when we are talking about AS 10, your property, plant and equipment, the first thing that we need to understand is when do we recognize a property, plant and equipment as an asset. Now first of all, what is that particular property, plant and equipment? Now any asset which can give you a benefit, a future economic benefit for a period exceeding more than 12 months can be called as a property, plant and equipment. Now that is the first thing. So when we are talking about any property, plant and equipment, it will have to deal with economic benefits which are probable to flow into the organization for a period exceeding 12 months. So when we are discussing about property, plant and equipment, we need to understand what is the definition of it. The definition of property, plant and equipment as per AS 10 says that it is an asset which is held for three purposes. First one, used in the process of production or for provision of services, used for rental to others, or used for administration purposes. Three purposes which have been specified as per as AS 10 is concerned. I would more or less concentrate on your administrative purpose because it has high significance when I am actually including this part into it. Now first of all, we have to talk about three uses. The first one, held for use in the process of production or for supply of services. Now when we are talking about process of production, I have a machinery which is being used as a production asset. Now definitely included as a property, plant and equipment. I am using a certain asset for supplying my service. Let's say I am being a chartered accountant who is actually providing a service. I use my laptop to provide the service. That becomes a property, plant and equipment for me. Held as rental to others. I own a bus which I have given it to a travel agent to run the bus on hire. Then basically income which I get is a rental income from that. So even such assets which derive rental income for me are also held as property, plant and equipment. And the third most important part is your administrative assets. Now what is this administrative asset that I am talking about? When I talk about an administrative asset, such administrative asset includes a lot of things. The first one, you can include even your assets like whether safety, security equipment, marketing assets. There could be some other assets which do not derive any economic benefit directly. Then why am I including it under property, plant and equipment? With the reason that though they do not derive any future economic benefits directly, they will help the organization to derive economic benefit from such asset, from the other assets in the future. For example, a safety equipment which is installed in a business premises is a legal requirement to be satisfied. Now such legal requirement when you're satisfying, does that safety asset give you any economic benefit? Absolutely no. But that safety equipment was necessary to ensure that the remaining assets within the premises are deriving my economic benefits indirectly. So always we have to make sure that we are identifying these administrative assets as a property, plant and equipment. The very important criteria is also that they should not be held for sale. Then only we can call it as a property, plant and equipment. And number 3, you should make sure that the economic benefits derived from such assets are always enduring nature. That means they extend beyond 12 months period of time. So these are the 3 main purposes, or these are the main things which are included in the definition. I'll repeat, saying that a property, plant and equipment as per AS 10 is an asset which is held for 3 purposes. Number 1, it can be used in the process of production or for provision of services. It can be held for rental to others. Or number 3, it can be held for administrative purpose. 3 uses, and making sure that they are not held for sale and are giving economic benefits of a period beyond one accounting period, that is 12 months. Now this is how you can define the particular standard. Now going with the recognition criteria, you need to understand that it should definitely give you a probable economic benefits arising from the asset, from the use of such asset. Now probable economic benefits, is it necessary for us to identify a quantifiable amount? Not necessary. Sometimes you cannot identify the quantifiable effect or a quantifiable impact of the economic benefit that you derive from a particular asset. Now for example, let's say A, B and C, 3 machines in combination are giving me an output or a finished good which is being sold in the market. Now when I sell them in the market, that product is basically generating some revenue. Now when I try to identify which machine has added a value to that product, I might not be able to actually allocate the revenue into each asset. So when we talk about probable economic benefits, it is only a benefit which we actually see but need not quantify. Even if we have an evidence that it has an economic benefit generating in use that is sufficient, quantifiable economic benefits need not be identified. Number 2, the cost of the asset should be reliably measured. Now measurement of cost is probably one of the most critical criteria as far as the standard is concerned. Now since I said critical criteria, let's try to understand exactly what is included in the cost. When I talk about cost of a property, plant and equipment, it basically includes 2 parts. Now this is something which is quite significant change which has happened here. One is the original cost at the time of initial recognition. There's no big change which is coming up here, but I will emphasize on where the exact impact is. One is the initial cost at the time of recognition. Number 2 is a subsequent cost. Now when we talk about subsequent cost being capitalized, we have some really interesting pattern which has been laid down in AS 10. Let's start with the initial recognition or the initial cost. When we're talking about the initial cost of any property, plant and equipment, it should include 3 things. First one is the cost of purchase. Second one is all the other costs which are incurred to bring the asset to the current location and the condition in which the management intends to use it. Now very important is the intention of the management there. And number 3 is a complete new thing which has come up now. It's called as provision for dismantling and removal. Now what is this provision for dismantling and removal? We will definitely discuss about. There are 3 parts which I emphasized on. First one is the purchase price or the cost of purchase, and the second one is basically the cost incurred to bring the inventory to the current location and the condition for the intention of the management accordingly. And the number 3 is your provision for dismantling and removal. 3 significant changes which have happened here, or 3 significant inclusions which are putting up here. The first one, purchase price, is quite the same as how we had in AS 10 as well. Purchase price includes per cost of purchases reduced by the amount of trade discount added with the amount of taxes which are not refundable. When I said non-refundable taxes, it basically indicates to those taxes which cannot be availed as VAT credit or VAT inputs. Got it? And then when we're talking about the other part, the second part which we are talking about is basically such costs which are incurred to bring the asset to the current location and condition in which the management intends to use it. Now, understanding first of all location and condition is very important. Location. First of all, when we purchase a fixed asset, such fixed asset is purchased at the supplier's location. But my intention to use it is within my factory premises. So there is certain cost which has incurred on that particular machinery to move from the supplier's location to my factory premises. What is the cost? Loading cost at the supplier's premises plus transportation which is incurred. During the transportation there is some toll charges which we have to bear, and also at the time when it reaches the factory we'll have to make sure that there is an unloading cost which is incurred. Now all this cost is incurred to bring the property, plant and equipment to its current location. So I said loading at the supplier premises, transportation costs up to the factory. Number three is basically your toll charges or octroi or whatever you pay during the transit. You can also include your transit insurance, and also towards the end your even unloading charges at your own premises. These are the particular things which you can include for bringing the inventory to the current location. Now current condition which I can say. Now current location and condition are complete different things. When I talk about a condition, in what way am I using the asset? Now let's say the machinery was bought in, is it ready for the use as and when? Not possible. Sometimes we might require to install it. Let's say I'm talking about an AC which is purchased. It's probably one of the most easiest example which I can take. When I have an AC which is purchased, an AC purchased from a particular retailer bought into the premises as such is not held for use. My management does not intend to use the AC as it is. First of all, we need to make sure that the AC is installed and then we start using it. So there is certain cost which we have to incur. That is the installation cost. There's also a quality check. That means making sure that the installation is basically done appropriately. And number three, we need to run something called as trial. Now we need to do a commissioning of the project. Commissioning of a project is compulsory because you need to know whether the property, plant and equipment installed is giving you the desired result or not. So that is the reason why a trial run is also incurred. So what are we talking about? Any expenditure incurred to bring the property, plant and equipment to the location and the condition in which the management intends to use it. Intention of the management is quite important here. Let's say for example, I have purchased a particular vehicle or a heavy vehicle, which a heavy duty vehicle which I am talking about. But my use as such is not like that. I wanted to customize it. I wanted to make sure that it runs like a food truck. Now food truck as such, when I purchase a lorry, it does not actually intend for the user, it does not actually suffice for the use intended by the management. So what do we have to do? After I purchase the truck, I have to customize the truck accordingly. I have to make sure that sufficient equipment is installed so that it can be used for the purpose as intended by the management. My intention to use it is as a food truck, so I have to make sure that sufficient modifications have been made to the asset. That is the reason why he says intended by the management. The word intention of the management is really important in understanding the definition of the standard. Next, going forward with it, the third inclusion which I was talking about is a complete different thing, or a complete significant change that we can talk about is your provision for dismantling. What is your provision for dismantling? Every asset has a provision for dismantling? Not necessary. My vehicle is also a property, plant and equipment, but does it incur a dismantling cost? Not necessary at all, because the vehicle is already in a moving condition. Now when I talk about a table, a chair is also a property, plant and equipment. Should I have a provision for dismantling? Not necessary, because it can be removed as such. But certain machinery which are especially earth, which are already installed at a particular premises or completely attached to a particular ground, I have to incur certain cost in removing that and making sure that I am again making the place ready for a machine to be replaced. All these costs, whatever I am incurred, whatever I might incur in future, will also be capitalized today. That means, to be very specific about, if I am purchasing an asset in the year 2016, intending to use it for the next 5 years up to 2021, and at the end of 2021 I might incur any provision charge, any dismantling cost. Such cost has to be estimated today. That is, in 2016 itself, I need to make a prudent estimate of what could be the cost that will be incurred at the end of its useful life, discount that to the present value and add it to the cost of the asset. Now this is something really significant, and such provision should be always measured as per AS 29. That is the existing standard which we have on provisions, contingent assets and contingent liabilities. Now making sure that your dismantling cost is always in a very subjective thing, because we are trying to make a provision for a future period. Now when I'm talking about the management estimate, probably 5 years of a useful life, it is easy. 10 years of a useful life, slightly difficult. If I say that my property, plant and equipment has 35 years useful life, then what could be the cost that will be incurred at the end of 35 years has to be identified as a prudent management estimate, discount it to the present value and make sure that you are adding it to the cost of the asset. Now that might require a significant effort from the management. So as such, when we're talking about, we have to make sure that we are collecting the entire evidence of on what basis the management has actually made that estimate. Remember, 3 inclusions that I'm talking about. I would conclude by repeating them. Number 1 is your cost of purchase. Number 2, cost incurred to bring the inventory to the current location and the condition in which the management intends to use such property, plant and equipment. And the last one is provision for dismantling and removal. And this is a new inclusion as far as the cost is concerned. And these are components of initial cost. That means the first cost. Now, however, sometimes it might be really difficult to even identify the initial cost as well. Now, why is that so? Simple logical reason. You can have 2 types of consideration in acquiring any asset. One is a monetary consideration, the other one is a non-monetary consideration. Monetary consideration is a consideration which is paid in the form of cash. So when I pay in the form of cash, it is quite simple, because when I pay monetary consideration in cash, it is simply the amount of cash which I paid. But when I'm talking about non-monetary consideration, that means where it incurs some exchange of assets. Let's say I have gave up an asset to acquire the other asset. Again, there is a non-monetary consideration in it. Or I have actually issued the shares of my company to acquire a new asset. Then again a non-monetary consideration coming into picture. Now these are non-monetary considerations and monetary considerations which we have to understand specifically. The first one, when I talk about monetary consideration, that means I am purchasing a fixed asset and the consideration for such property, plant and equipment will be paid in the form of cash. Now the first question arises whether you are having a credit or no. If there is no credit, no problem, because the standard uses the word cash price. When I am using the word cash price can be actually interpreted as a normal price which is charged by the supplier for a normal credit terms. So normally the supplier of the property, plant and equipment has been offering a 40-day credit period. Then on what is the price which is offered at 40-day credit period should be considered as a price for identifying the asset. However, sometimes there could be a situation that we might see where the credit period allowed by the supplier or the credit period availed by us is much beyond the normal credit period. A normal credit period was 40 days, but I availed the credit for 1 year, that is 365 days. Now definitely you need to understand that the price which is being charged cannot be the same. The supplier will definitely add some portion to it, like how we see in a hire purchase agreement. Hire purchase agreement is one classic example where we can say that my cash price plus interest cost is equal to the hire purchase price. So any transaction in a hire purchase will always be executed at a hire purchase price. Why is that so? Because in a hire purchase transaction, the consideration is not paid at one shot. It is paid in installments which are spreading over a certain period. Now that is the reason why he adds something called as an interest cost which is added to the cost of the asset. Now same way, when we have a delayed credit or an extended credit, if the credit is extended much beyond the normal credit terms, then we need to understand the difference between both. What is the price at which the transaction is executed? What would have been the cash price if the transaction was executed at normal credit terms? If I would have purchased at 40 days credit, which is a normal credit, what could be the price? But instead I have taken a 1 year credit, so what is the price? the difference between these two will be called as interest component. And such interest component, as far as AS16 is AS10 is concerned, we will not deal it here. Such interest component, whether it is eligible to be capitalized or not, has to be dealt as per a specific standard that we have, that is AS16. AS16 is talking about borrowing cost, where we exactly understand what could be the interest cost and when could be such interest cost actually capitalized to your cost of property, plant and equipment. Got it? So basically I'm talking about monetary consideration still, and I said whenever there's a monetary consideration being paid for acquisition of a property, plant and equipment, we need to understand its cash price. So what is the cash price? Is my initial cost to be recognized or capitalized. But if in case such a property, plant and equipment is acquired on deferred credit basis, deferred credit settlement, then we have to understand the difference between the price as per normal credit terms and the price charged as per deferred credit terms. The difference between these two will be called as an interest cost and has to be dealt as per AS16, that is your borrowing cost, whether it is capitalized or not. To take an extract of AS16, it can be capitalized, that such borrowing cost can be capitalized or such interest cost can be capitalized only if such asset is a qualifying asset. Clear? So that is in the AS16 we have certain conditions for qualification, so capitalization. So we can talk about that as a part of AS16 but not as a part of AS10. So let us confine ourselves to AS10. We were talking only about monetary consideration. Along with the monetary consideration, now comes your non-monetary consideration as well. Now when I am talking about non-monetary consideration, I have given examples of exchange of an asset or an exchange of a security to acquire the property, plant and equipment. In such basis, whenever there is a non-monetary consideration, always understand that we need to recognize it at the fair value of the asset which is acquired. Now, what if a fair value cannot be ascertained? That will be the first question. What if the fair value cannot be ascertained of the asset acquired or the asset given up? In such cases, we will restrict ourselves to only the carrying value of the asset which is given up. So if my asset which is given up has a carrying cost, that means already after depreciated cost of about 150, even though the price of the asset, the fair value of the asset acquired might be even more, but still I will restrict myself to be recognizing only to the extent of the carrying cost of the asset which has been given up. But if in case I can identify the fair value of an asset given up or the asset acquired, if both are available, then which one should I consider? Should I take the fair value of the asset acquired or should I take the asset of the fair value given up? In such case, it has concluded by saying that please consider what is the fair value of the asset given up or the security which has been issued. Then this is basically what exactly the standard talks about. And whichever is more clearly evident is what he uses. Whichever is more clearly evident when both the fair values are available. Now let's say I am talking about securities in a market. If my company is a listed company and has shares which are regularly traded in an active market, then the price of the share is quite clearly evident than the fair value of the equipment or a property, plant and equipment which is acquired. In such case, I will more or less rely on my value of securities or fair value of securities rather than the fair value of the asset being acquired. Got it? So this is what we can talk about. So normally when I talk about non-monetary consideration, be it an exchange of an asset or an exchange of a security, we need to confine ourselves to say that always recognize it at fair value. Fair value of what? Fair value of asset given up or fair value of asset acquired, whichever is more clearly evident is basically the terminology being used. However, if we are not in a position to identify either of the fair values, I don't know what is the fair value of the asset given up, neither I know the fair value of the asset acquired. In such case, we will continue to recognize even the new asset acquired at the carrying cost of the asset which is given up. So that is basically when we are talking about non-monetary consideration. However, certain transactions I cannot record at fair value. Now, even though there is a non-monetary consideration, I have a restriction on using the fair value if I have two situations which have cropped up. The first one, where the transaction itself lacks a commercial substance. Commercial substance is lagged. That means I am starting my own office at a point of time and someone to an opening of my office has come up and wrapped a nice gift and gave it to me. And when I opened the gift, I found a printer which is being used in my office. Now what is the cost? There is no commercial substance. I cannot recognize such asset at all because it lacks commercial substance. And the other one, like I already told you, that when fair value cannot be identified, always identify the asset at its carrying cost of asset given out. Clear? So these are the two non-monetary considerations, or these are the two situations when a non-monetary consideration cannot be recognized at fair value. So the first one, when we are talking about, it cannot identify the fair value of either of the assets, or when the transaction itself lacks a commercial substance. Yes guys, moving further into the standard, we'll have to talk about something very, very crucial, that is your spare parts and standby equipment. Now if you remember, earlier standard also addressed this issue. Talking about spare parts and standby equipment, the previous AS10, which was already there, which is now replaced with PPE, earlier was talking about saying that it can be capitalized. Your spare parts and standby equipment can be capitalized as per AS10 and can be recognized as per AS10 provided two conditions were satisfied. One, it was not an interchangeably used machinery spare. That means the machinery spare is specific to a particular asset. I cannot use that such spare for any other asset in that category. Now second one, the use of such spare is irregular. Two things which I am talking about, it can be specifically used only for that particular asset, and second thing is that the use is irregular, then it is eligible to be capitalized under AS10, and if these conditions were not satisfied, we were recognizing as an inventory under AS2. However, the revised AS10, that is your property, plant and equipment, talking about your standby equipment and your machinery spares, it says that it is also eligible to be capitalized. Then what is that very, very new thing which is coming up now? He says that it can be capitalized provided the recognition criteria is satisfied. Now when I talk about what is this recognition criteria means number one, first of all, it should meet the definition. What is my definition? An asset which can be held for three purposes: use in the process of production, or for provision of services, or for rental to others, or for administration purposes. Second one, it should have an economic benefits which is probable to flow into the organization from its use. Number three, the cost of such asset can be reliably measured. If these three conditions are satisfied, that is your recognition criteria is satisfied, then you can treat such machinery spare or a standby equipment as a fixed property, plant and equipment as per the AS10. So understand, some major tools which were earlier classified as inventory, if they are satisfying the definition of property, plant and equipment and they are meeting the recognition criteria laid down under AS10, will now have to be reclassified. They'll have to be restated, and we'll have to make sure that such tools will be now classified under AS10 and depreciated and cannot be held as an inventory under AS2. However, if such a machinery spare or a standby equipment or the tools are not satisfying your recognition criteria, then they will be recognized as per AS2, that is your inventory. This is the first part that we need to understand about machinery spares, standby equipments and tools. Moving subsequently, we'll also have to address something regarding your unit of measurement. What is a unit of measurement? A unit of measurement in the sense, what do I call as one unit of property, plant and equipment? Let's say I have a pool of 20 benches. Now such 20 benches put together, can I call it as one PP, or should I individually identify each bench as a PP? In this case, we'll have to use a materiality concept into consideration. Now as per your materiality concept, if I say that each individual asset is immaterial, then it is reasonable to consider a collection of such similar items as one single property, plant and equipment instead of recognizing each asset individually. Got it? So unit of measurement completely depends upon what is the volume and the value of such particular property, plant and equipment. If I have low value items but huge in number of volumes, then we can club all of them and together we can call it as one property, plant and equipment and depreciate accordingly. So this is also discussed as per the standard. Then we can move into the next one called as consolidated price. What is a consolidated price? That means if I have a pool of assets like asset A, asset B, asset C, asset D, all the four assets purchased together with a one single price, then we will have to decide upon what is the price, what is the capitalization cost which can be allocated to A, B, C and D. Now what he says is, such consolidated price paid should be allocated to A, B and C and D, that is each individual asset for which you paid a consolidated price based on their fair value. What is the proportion of the fair value of each item? That should be identified, and in the same proportion of the fair value of the items, we'll have to allocate the consolidated price which is paid. Now, there could also be a situation where a cumulative effect or an additive effect of all the fair values might still be lower than the consolidated price that you paid. Then why did you pay that extra price? You could have very well even acquired each individual asset independently. Why should I acquire all the asset put together at one cumulative price? Then he says that the difference, if my sum of fair values of all the individual assets acquired is less than the amount of consolidated price, then the difference between these prices, that is the sum of independent asset fair values and the consolidated price paid, this will be classified as goodwill. Now this was a concept which was there earlier and has also been adopted under AS10, that is your revised AS10, that is your property, plant and equipment. Now moving further, when I talk about components of cost, I said any property, plant and equipment will have two costs. One cost which is capitalized at the time of initial recognition, then we come into the subsequent cost segment. When we are talking about subsequent cost, whether the subsequent cost incurred on a property, plant and equipment is eligible to be capitalized or not, that will be a question. Now first of all, we need to understand that there are certain expenses that are incurred recurring on a property, plant and equipment, like its maintenance, like its servicing. Now such regular items which are basically incurred on the property, plant and equipment on a time to time basis are not eligible to be capitalized. However, if there is a replacement of a part, then let's take a reference of the previous standard. If I replace the part of a machinery or a property, plant and equipment, it is eligible to be capitalized only if it enhances the value of the product. Now when I talk about this enhances the value of the good, then let's talk about, let's say I have a particular vehicle. Now the vehicle has a useful life of approximately about 5 years. However, the tires which are fitted to the vehicle might not be running for the entire 5 years period, because the vehicle tires will have a different useful life, like 40,000 kilometers or 50,000 kilometers. You cannot value a tire based on the period. A tire does not run based on 5 years or 4 years. It depends upon how many kilometers you are running. So at some point of time, we will have to replace the tires during the useful life of the asset itself. When you capitalize the asset, we capitalized it along with the tire. Now when I am replacing the tire, if you are going with the earlier standard, I would say that it is not actually enhancing the use of the asset, because earlier also it was going on the road, even now also it is going on the road. It is not flying in the air saying that there is some additional utility that you are getting from that. So we used to treat it as a revenue expenditure. However, with the revised AS10 came in a very good adjustment which is coming up right now, is saying that any cost of replacement is eligible to be capitalized, provided at the beginning we have to make sure that any fixed asset has to be identified as per all the significant components. That means whenever I acquire an asset, I will not treat the asset as single component. I'll have to make sure that I'm capitalizing the asset based on the components it has. Let's take for the example of a car. I will say that the life of the car is basically 5 years, doesn't mean that every component of the car is basically gonna run for 5 years. I have a tires which have a significantly different useful life. I have a gearbox which has a significantly different useful life. I can have n number of components which has a significantly different useful life of the part, distinct from the main car which we are talking about. So then basically what we try to do is, an asset acquired will be broken down into all the major components and be recognized separately. In such case, if one of the major component is being replaced, then how do we actually do it? Such replaced cost of the asset will have to get capitalized. Then what about the cost of the asset which is already there? Let's say I have replaced the tire. Now the tire's capitalizing cost, whatever cost I have incurred, is eligible to be capitalized. Then what about the cost of the tire which is already included in the cost of the asset when you earlier acquired it? Because when I purchased it at the beginning, let's say I paid 10 lakhs, then I paid 10 lakhs even for the tires. I did not pay separately for the tires as such. But when we are capitalizing, I said we will identify the major components and make sure that we are recognizing separately, and we will also depreciate it separately. Then in such case, the carrying cost of the old tires, what is existing in my books of accounts, will be derecognized, and whatever is the additional cost which I have incurred now to replace the tires will be added to the cost of the asset. So what am I trying to put across? If there is a replacement of a major component of an asset, then instead of treating it as a revenue expenditure, even though it is not enhancing the performance of the asset, but still I am eligible to capitalize the cost, that we have to make sure that we are derecognizing the carrying cost of the earlier component. The earlier component might be depreciated and might have a carrying value. Such carrying value should be derecognized, and the additional cost incurred should be capitalized into your cost of the asset now. So basically, what is your impact on the P&L? If you assess earlier, every replacement, if it is not enhancing the performance of the asset, was treated as revenue expenditure charged to my P&L. So my charge to P&L always used to be more. But now, if I am saying that it is entitled to be capitalized, then what happens? My charge to P&L is only the derecognized component. Derecognized component is not at cost. It is cost minus accumulated depreciation on that. So my charge to P&L will be more, and my addition to the cost of the asset will increase because of your new replaced component. So that is the reason why we have to understand this spare part, or sorry, this subsequent cost very specifically. This is the first time we have come across such an adjustment, and one of the adjustment which actually makes more sense. But there could be hundreds of doubts arising now. What if? Now what ifs? Let me answer what if now. What if I haven't recognized that component earlier? It was a major component. However, at the time of capitalizing that particular asset, I failed to recognize the component as a separate part. Then how do I do it? Now should I now still capitalize the replacement cost of the asset? Now that is a issue which comes up. I haven't identified the component at the beginning or at the time of initial recognition. Now I have replaced the component today. Should I treat the replacement cost as a capitalized cost, or should I treat it as revenue expenditure? Then he says no issues. Even though you haven't recognized it as a separate component at the beginning, at the time of initial recognition, a replaced cost can still be capitalized. Then how do I identify what is the carrying cost of the component which should be derecognized and charged to P&L? He says, when you cannot identify from the carrying cost of that replaced part, then make sure that you are identifying the carrying cost of the replaced part based on the replacement cost. That means, let's say I have incurred 100 rupee on replacing a part today after 3 years. Then what we'll try to do? We'll try to say that earlier I haven't recognized this component as a separate component when I was initially recognizing the asset. So this replaced part 100, we'll assume that as if that 100 was incurred at the beginning, and we will start depreciating it over 3 years. So that is replacement cost. Today, that 100 rupees cost which was recognized 3 years prior to it might be after depreciation about 60. But today I have incurred 100 to replace it. 100 will be added to the cost of the asset. That 60, what is the carrying cost of the asset based on the replacement cost, will be charged to your P&L. So even though you haven't identified a component at the time of initial recognition of an asset, it is still eligible to be recognized. It is still eligible to be recognized or capitalized to the property, plant and equipment based on the replacement cost approach. Clear? So whenever we are talking about this replacement cost, also you need to be very specific. So first thing, we have significantly understood component approach. That means any time when we purchase a particular property, plant and equipment, we have to make sure that we are identifying the major components of the property, plant and equipment and have to recognize it separately, so that next time whenever we replace the component, then the carrying value of the replaced component has to be charged to P&L, and the new cost, whatever we have incurred in replacing the component, should be added to the cost of the asset. Even though we haven't identified the cost of the component earlier, it is still fine. We can go over a replaced cost approach, making sure that the cost of replacement will be treated as a cost at the beginning of the year, identify the carrying cost today, charge it to P&L, and add back the asset or add back the cost of replacement to the carrying cost of the asset. So this is a new technique of component approach which was not there under AS 10 but newly introduced as per the revised AS 10. I wouldn't say it was not there, but earlier he said identifying the asset components of an asset, major components of an asset is recommended. But now recommendation is not there. This has become a mandatory requirement as far as your new standard or the revised standard is concerned. I can use the similar components for identifying inspection cost, because whenever I capitalize the asset, I told you we were talking about a second cost to be included at the time of initial recognition was cost incurred to bring the property, plant and equipment to the current location and the condition in which the management intends to use. So to bring it to the current condition, there should be an inspection cost which is normally incurred. In all the major property, plant and equipment, we identify something called as inspection cost. Such inspection cost initially we capitalize it. Now whatever is capitalized, if I have to go for a subsequent inspection cost, let's say I am talking about aircraft. Aircraft, I cannot actually inspect it only once at the time of initial recognition. There could be a subsequent major inspection cost which is incurred on a periodic basis. Then in such cases, even such major inspection cost is eligible to be capitalized. Now how do you capitalize? A simple thing. Whenever you have an inspection cost initially incurred, recognize it as a separate component and depreciate accordingly. Then whenever you have a subsequent inspection which happens, such a subsequent inspection cost is capitalized and the carrying cost of the earlier inspection cost will be derecognized and charged off to P&L. Now as simple as any other component. So even inspection should be treated as a separate component and cannot be treated as a combination to the original property, plant and equipment acquired. Clear? So this is another part which we have to really emphasize upon. So yes guys, moving further into self-constructed assets. Now what is the self-constructed assets? Basically, if a company makes an effort to make their own set of property, plant and equipment. Let's say for the purpose of delivery, I wanted some delivery bins from where the stock can be picked up. So I use my own inventory to make those stands where basically the goods can be stocked. Now such things are basically my property, plant and equipment which were constructed by myself. I haven't actually purchased it from someone else. So such assets are called as self-constructed assets. Now when I'm talking about recognition of these assets, you need to be very specific. The first thing, let's say this was my ordinary course of business. Me making such delivery bins was basically my ordinary course of business which I would have provided as a service to even the outsiders. In such cases, how do I even identify the cost of these goods? Simple. The cost eligible to be capitalized in such cases when the self-constructed asset is generally made in an ordinary course of business is based on your inventory valuation as per AS2. So that means we'll have to go for AS2 approach which includes three parts of cost. Number one, cost of purchase. Number two, cost of converting the raw material into finished good. Number three, any additional cost incurred to bring the inventory to its current location and condition. These are the three components of cost treated as per AS2. Same thing should be included even now when we are trying to capitalize the cost of such inventory. However, when we are talking about such kind of usually made goods which are normally in inventory but now capitalized as a PPE, since I am using it by myself, then in such cases any internal profit has to be eliminated. From one segment to another or from one department to other, if there is a loading being added, we have to make sure that we are nullifying the loading when we are capitalizing the cost. Because I am using the word cost, so I cannot add any loading into it. Now continuing with that, I would say that any additional cost which is incurred on wasted material, wasted labor cannot be forming part of cost of self-constructed asset. How is it different from what we had earlier? Earlier under AS10, that is your fixed asset, we said that cost eligible to be capitalized is such cost which is incurred until the asset is ready for its intended use. If I put it such way, let's say I have incurred a cost on a trial run and such trial run resulted in a failure. That means I did not get the desired output. So what do? I try to make necessary changes and again put the asset for a trial run until I get a desired output, and when I get a desired output, I'll say that this particular asset is ready for its intended use and all the costs incurred until that time are eligible to be capitalized. In such capitalization, I would have included even the failed trial run cost. But however, when the revised AS10 is specific in actually determining these amounts and saying that any wasted material and wasted labor cost cannot be eligible, cannot be made part of your property, plant and equipment, they are not eligible to be capitalized is what he said. So that means all that failed trial run cost of material which are involved in the trial run, the labor cost which is incurred during the trial run are not eligible to be capitalized. Now talking about interest cost, because self-constructed asset normally might take a significant period of time or a substantial period of time to get ready for its intended use. In such cases, your borrowing cost is eligible to be capitalized subjected to your AS16. That means it needs to satisfy the definition of qualifying asset, and then according to AS16, whatever is the borrowing cost eligible to be capitalized, that is capitalized under AS10, that is property, plant and equipment. Now that is regarding your self-constructed asset. Now when we are talking about your recognition of a property, plant and equipment for subsequent years. Till now we were talking about initial recognition. That means at the year 0, when I acquire the asset, when I make the asset, when I acquired pool of assets as a consolidated price, we have tried to identify, or when we have tried to discuss about each component. But now I am talking about subsequent recognition. That means year on year recognition of a property, plant and equipment. In such cases, he says there are two methods of identifying for subsequent years. Earlier we had always been saying that a subsequent recognition is cost minus accumulated depreciation. Now I would say that is one of the way to approach it. But now we have an additional method of subsequent recognition called as revaluation model. What is the difference? The first one is a normal one as per AS10 cost model. In a cost model we try to identify cost minus the accumulated depreciation on all that property, plant and equipment can be recognized as your subsequent cost. However, under revaluation model, what we try to do is we try to revalue the asset at all the periodic intervals. Now periodic intervals, when I am talking about, it need not be annually. Sometimes a period which is much shorter than 1 year could also be a periodic measurement of your revalued amount. So I try to identify what is a revalued amount at the end of each financial year and make sure that that will be recognized as my cost of PP. Then what about the depreciation component? Am I missing something? Not at all. Because what he says is the revaluation at the beginning of the year minus the revalued amount of the asset at the end of the year, the difference between these two will be charged to P&L in the form of depreciation. This is called as revaluation model. So two models that we discuss about: cost model, which is our original model, that is the acquisition cost minus accumulated depreciation. Second one is a revaluation model, where the revaluation at the beginning of the year is compared with the revalued amount of property, plant and equipment at the end of the year, and the difference between these two will be charged to P&L. Now when I am talking about revaluation model, I will discuss about cost later on, but let's come down to something really new and really interesting. For the first time we are looking at something called as revaluation model. Whenever I talk about revaluation, now first of all, how do I identify? He says revaluation of a property, plant and equipment is the fair value of the asset. How do I identify fair value now? First of all, revaluation is saying, now a new terminology called fair value is used. Now how do I determine fair value? He says fair value can be recognized as per approved valuer. Who is this approved valuer? Should he be an independent examination? Not necessary. Not necessary, because the standard hasn't specifically said that should be an independent valuer who is giving it. He just said it is an approved, qualified approved valuer. Now qualified approved valuer could very well be any chartered engineer who is employed within the organization itself. So an independent valuation probably might be required or might become necessary for the auditor to believe in the value, but as such, by strict compliance to the standard, there is nothing which is actually asking a company to go for an independent valuation for identifying the revalued amount. Clear? However, the standard has confined itself only to two models of identifying the fair value. The first model is called as income model. That means we basically use discounted cash flow approach. What is discounted cash flow approach? My future cash flows which are generated from the asset should be identified, should be discounted to the present value, and that can be called as your revalued amount or the fair value. Second one is called as depreciated replacement cost approach. What is this depreciated replacement cost? That means if I would have acquired the asset today, what could have been the cost? That will be identified, and make sure that you are having a accumulated depreciation which is reduced out of that, and that will give you what is the present value. For example, to make it much more clear, let's say I have an asset which is acquired in 2010, and today I am standing on 31st March 2016 trying to identify the fair value as per depreciated replacement cost approach. Then I will say that what is the cost of the asset if I would have acquired today. I'll take that as a value on the date of acquisition, that is 2010, and try to depreciate the asset for 6 years period. Now I took a replacement cost, I tried to depreciate it for all the past period, that is 6 years, and now whatever is the depreciated replacement cost approach, that will be treated as a fair value of the asset. So two approaches in identifying fair value: income approach, that is discounted cash flow, or depreciated replacement cost approach. Two different ways of identifying the fair value. Now talking about the periodicity, can I have a periodicity of fair valuation beyond 1 year? Possible. Sometimes he says that the standard has never talked about periodicity of fair valuation. It can extend beyond 1 year provided the facts of the case are there, saying that there is not a significant change in the fair value of the asset from the date on which it was last valued. Sometimes there could be a value of a property, plant and equipment which might not have a significant impact year on year. In such cases, you can go for a bi-yearly or a 3 years once fair valuation as well, but always recommended to have a fair valuation done at least once each year to have a better measure of the fair value or the replacement cost model. Now we will have to move back to our cost model, which was our original model of depreciation. When I talk about cost model, that means cost model of subsequent recognition is cost minus accumulated depreciation. Now when I am talking about cost minus accumulated depreciation, how do we depreciate? What are the factors which are contributing to a depreciation? He says there are 3 factors which contribute to depreciation. Number 1, cost. The first reason is wear and tear on use. Number 2, effluxion of time. How are you using it over a period of time? Number 3, obsolescence of technology. 3 reasons why a depreciation is required to be charged as per cost model. When I charge depreciation, how do I charge depreciation will be the question. Depreciation charged to the P&L each year should represent the pattern of utilization of property, plant and equipment. Now pattern of utilization of property, plant and equipment, how do I establish? Is it so different for each asset? Yes. Let's talk about a vehicle. When I purchase a vehicle, the first year 1, we normally make sure that the vehicle is used to the full capacity, because always we try to make sure that it is neat and clean. Wherever we go, we make sure that the vehicle is taken along with us. So my utility graph, if I talk about, is initially high and subsequently it slowly gradually reduces. But whenever I talk about a machinery which is trying to produce a new product, then what do? First I produce in small quantity which are being distributed as samples into the market. Now let the samples be consumed, let the people get used to my product, then slowly year on year I'll keep on increasing. First year 20% production, second year 40% production, third year 80% production, fourth, fifth, sixth year I get 100% production. After that again the productivity of the machine keeps falling. So if you look at the graph, it will be low at the beginning, gradually increases, again falls towards the end. So that is a pattern of utilization of certain plant and machinery. So I have taken 2 examples where we have a significant change as far as the pattern of utilization of a property, plant and equipment is concerned. Now such cases he is talking about, he is saying always follow a distinct approach of depreciation. Always the depreciation charge should represent the pattern of utilization of such property, plant and equipment. Now the question arises, how do I even depreciate? Depreciation, like we always know, is cost minus estimated residual value divided by estimated useful life. This is our normal thing. But what is the change? Now what he says is, it is compulsory for an organization, it is a mandatory for each organization to always check for the estimated residual value and the estimated useful life to be reviewed each year. At least once each year, we have to make sure that we are reviewing what is the estimated residual value. What is the residual value? That means at the end of the useful life, at what price would I sell the asset? That amount, and how many years am I intending to use the asset is my estimated useful life. These two figures each year have to be compulsory reviewed. It said at least once each year. You can do much beyond that as well, but once at least each year it has to review what is the estimated residual value and estimated useful life. Along with that, we have to even understand that whenever there's a change as far as your estimated residual value is concerned or estimated useful life is concerned, these are called as change in accounting estimates, and such change in accounting estimates have to be recognized as per AS5. AS5 is talking about your net profit or loss and changes in accounting policies. Now in that particular standard, we have discussed exactly about what is the impact when there is a change in accounting estimate. However, when we're talking about the method of depreciation, now comes the logic. Whenever there's a method of depreciation being followed, sometimes there could be a difference in the even subsequent change in the method of depreciation followed. Earlier I followed an SLM, WDV. First of all, let's come back. There are plenty of methods of depreciation being there. SLM, WDV, sum of digits, you have machine hours method or production units method. So many methods are there, but which method should I apply according to your revised AS10? The revised AS10 is silent about the method to be applied. It just says that you need to make sure that you are actually identifying the pattern of utilization of the asset and apply the pattern of utilization in charging depreciation. No particular method being specified as per AS10. But let's say, understanding the pattern of utilization, we have derived saying that sum of digits is probably the most appropriate method of depreciating a particular asset X. Subsequently, after 2 years, we have understood that sum of digits method is not exactly the approach which I wanted. So now I have changed it. I have revised the sum of digits method back to SLM today. So that means there is a change in the method in which your depreciation is being charged. Now how do I treat about this? He says that a change in method of depreciation should always be treated as an accounting estimate. Earlier, if you remember, a change in a method of depreciation as per the earlier AS10 was treated as a change in accounting policy and always given a retrospective effect. But now with the revised AS10, a new provision coming into picture which is replacing the earlier one, saying that a change in depreciation method should only be treated as a change in accounting estimate and should only be given a prospective effect. So retrospective effect is not possible when there is a change in accounting policy, or when there is a change in method of depreciation. Now this is one more very important thing. Now let's try to discuss about. We said that the fixed asset is not identified as single asset. We'll have to identify significant components of the asset and capitalize it separately. Now, should I charge the same rate of depreciation on all components? Then if you charge the same rate of depreciation, the purpose of identifying the components itself is defeated. So what we have to do, you have to make sure that each component of the fixed asset should be identified to have a distinct useful life and should be depreciated in a different methodology completely. Few parts you can use a SLM, few parts you can use a sum of digits, few components you can use a WDV method of depreciation. Different components, different methods. But if two methods or two components are having a similar use and should be depreciated as per the same method, then you can treat these two components as a single component and capitalized. Got it? Because the purpose of componentization is to make sure that depreciation is charged on each component on a different way or the most appropriate method of each component basis. This is regarding your depreciation. So depreciation, always make sure that you are reviewing your useful life, reviewing your residual value at least once each year. And the other significant change that we are talking about is whenever there is a change in the method of depreciation followed, we are not going to treat it as a change in accounting policy. We are not going to give a retrospective effect. We are only going to give a prospective effect. We are only going to treat it as a change in accounting estimate and should be treated as per AS5, that is your accounting for accounting changes in accounting estimates. Got it? So this is as far as your changes are concerned. Yes guys. So revenue based depreciation is a new method which we have to discuss. Now is it appropriate to actually go by a revenue based adoption? What is depreciation? Depreciation charge to P&L should represent the pattern of utilization of the property, plant and equipment. So can I say that the revenue derived from the use of a particular asset can I take it as a pattern for utilization, or can I use it as a pattern of depreciation? Then the answer is no. The AS10 very specifically discourages the use of revenue based depreciation. Now why is that so? Because a revenue generated from a property, plant and equipment need not be exactly based on the pattern of utilization of the asset, could be based on plenty of other factors. The demand of the product, or the price fluctuations of the product, the material increase as far as the price is concerned. So there could be plenty of factors, like even the competition existing in the market, which might actually move the revenue, and so it need not exactly be a pattern of utilizing your benefit of arising from the asset. Clear? So that is one more thing which we have to discuss about. Now going further, we will discuss about land and building. Now most of the times when I acquire a building, I cannot acquire the building as such. How can I acquire a building without acquiring the land? When I acquire a building, obviously I am having a land which is coming along with the building. Now if I buy the building alone, should I take the building in my hands, or should I lift it with a crane and put it elsewhere? Obviously no. When I buy a building, that means I am also paying a price for the land as well. So land and building, when you are actually acquiring in a combination, then the standard says make sure that you are making efforts to identify the component of land and the component of building in a significantly different manner. Make sure that you're making efforts to identify the cost of land and cost of building separately. Now what happens when we do this? Why are we even trying to do this? Because depreciation cannot be charged on the land, but should be compulsory charged on a building. So that is the reason why we have to make sure that we are bifurcating the value of the cost of land and a building, and we have to make sure that we are going forward. How do I bifurcate? The bifurcation between the consolidated price is always on the basis of fair value of the land and the fair value of the building. Clear? So land and building, make sure that we are not identifying as a single asset. We have to make sure that we are always identifying both as two distinct assets. Make sure that you are charging depreciation on the building, but no depreciation being charged as far as your land is concerned. Now, one more topic that we'll have to discuss about is when we actually define the property, plant and equipment, we said it can have three purposes. Number one, use in the process of production or for provision of services. Number two, held for rental to others. Number three, administrative purpose. I am talking about this part, that is sale to others, rental to others. When I hold a property, plant and equipment which is basically held for giving us a rent to others, if my property, plant and equipment was primarily held only for the purpose of renting it out or earning income in the form of rental from others, in such cases, whenever that asset is subsequently held for sale, it was initially a property, plant and equipment held for rental to others, subsequently at the end of useful life you are holding it for sale, and on such date when you are holding it for sale, now I'll have to treat it as an inventory as per AS2, and I cannot continue to treat it as AS10. I'll have to change the classification. I'll have to push them under inventory and treat it as per AS2 inventory, treating it as lower of carrying cost or the net realizable value from such asset. And the sale proceeds from such asset. Sale proceeds from a property, plant and equipment which was originally held for rental to others. If I subsequently sell, then the sale proceeds will be treated as revenue under AS9. It should not be treated as derecognition of PPE, because derecognition happens at the time of reclassification. At the time when I said it was held for sale, that time itself we have treated it as inventory, and such proceeds of sale is only treated as a revenue under AS9. Clear? So this is one more really important topic for us to discuss, and other than this, there's nothing as far as your AS10 is concerned. All the significant changes have been addressed except for the transition provisions.